On the podcast with us today is Lucas Miller. Lucas, welcome to the podcast.
Oh, thanks for having me. I really big fan of you and the show, and I'm just glad to be here. So I appreciate the invitation.
Awesome. Well, I'm looking forward to diving into this asset called Woodmere Reserve that you closed in December of 2020, 200 units out of Montgomery, Alabama. So before we dive into that property, though, let me have you start us off and give us a little bit of a background about yourself and also where you are right now as far as the multifamily side of things.
Yeah, background for myself. So I'd probably have a very similar story to a lot of your guests and probably a lot of your listeners. And I got started, didn't really enjoy my job. And so I wanted to make more money. I wanted to make a lot of money. And so I figured real estate's a great way to do that. Turns out it's a lot tougher than the books make it seem. And so I took a really long path to get to where I'm at right now, including flipping houses, getting small rentals, even doing some private lending for a while. And eventually just decided I didn't like being a mom and pop operator, if that makes any sense. I don't like the idea of small rentals because I feel like I have to be the operator there. Until you get to a scale, you can't afford the nice software, the nice property management companies. And so I didn't like that, the amateur status of that, if that's a good way to be it. And that's not a pejorative at all if you're a small landlord right now and you enjoy it. I just didn't enjoy it. So my goal was to eventually build a business, not be a real estate investor. And so the biggest way to do that is to get as many units as you can right away and grow that to what it could be. And so multifamily is a great way to do that. Some people choose different asset classes, but I really enjoyed multifamily. And so that's what I stuck with. And then I think when you think of multifamily, you think of a lot of units, which is great, but you don't really know how to get there. And so the scale was a little overwhelming for me. And so I actually sought out a mentor. I sought out someone to help me with this. And, that was a great step in my mind to get to where I'm at now. It kind of was like strapping on rocket boosters. It really allowed me to get to scale. And so that led me to a few deals. And then eventually, a few years later, we got to Woodmere Reserve, or it was actually called Legacy at the Lake for a while, but that was in Montgomery.
Awesome. Well, let's dive into this deal right now and talk to us about how you sourced and you found this deal.
Yeah. So I was working with a partner and he actually was the one on the ground sourcing the deal. He had a really great relationship with this broker and that's kind of how we've been working. We've been dividing and conquering. I have my markets that I'm on the ground working in. He has his. So this was brought to him, obviously pre-market, wasn't marketed at all. And the seller was sort of a bigger name, and they were just moving out of the Montgomery area and selling their portfolio there. And this was a 2-property portfolio, and the other property was 90s product and was actually scooped up on a all cash deal. And so it was just had this 200 unit deal left. It was mid 70s construction, and we just picked it up and decided to do a little bit of underwriting. And this deal was actually really interesting because it was a little more work than we normally do, a little more rehab. And I think we ended up spending somewhere around 14,000 units, or at least underwriting that much to get this closed. Of course, we just closed a couple months ago in December, so we don't have the full cycle in it yet, but that's our underwriting right now. So it needed quite a bit of work.
And is the 14,000 per unit, is that interior renovations?
That would be total. That's our rehab budget. So that includes some exterior stuff as well.
Okay. We'll get into the details, a little bit of kind of what your plan is on the interiors and exterior and stuff like that here shortly.
Sure.
On the acquisition side, when you made the relationship with this broker, at what point did you go out and actually tour this property?
So my partner, Tim, he went out and was on the ground. We already own a property in Montgomery, so we're on the ground pretty regularly there anyway. And every time we go on the ground, we reach out to brokers, obviously, and say, hey, we're going to be in town. Do you have something we can drive while we're there? And they'll kind of give us hints, little breadcrumbs, say, hey, go drive around this area. You might want to go look at this property. So he had seen it before it was actually on the market. A lot of brokers do this. They reach out to you and say, we're in the pipeline, or so to speak. This seller's thinking about selling mid-December or in the spring or in the summer. Why don't you go take a look at this? So we had little breadcrumbs here and there that we knew this was coming up, and we knew we liked the area. And so he went and looked at it. And then I believe a couple weeks later, maybe a couple months passed, and then it officially popped out. The seller was ready.
How many rounds of offers did you go through?
This one was pretty. This one was a little different. So there weren't a ton of offers on the table just because of the sheer scale of the amount of work. So this one was, if I remember correctly, this was just a 1-round offer. We submitted it. There was no best and final.
Mm-hmm. What was the final purchase price?
Final purchase price. Let me get that. The final purchase price was $9,250,000 on the dot. And the reason that was off my mind is we actually went through quite a long closing process because there were some things that came up during our inspection period that weren't necessarily disclosed. The seller actually didn't even know about them. And so we had to do a reduction in price. And so we got, I think, $400,000 off the price because of that.
So the 1970s product, C-class property, I'm assuming, being about $46,000 a unit. And $9.25 million purchase price. And at what point, or on this particular offer, I'm assuming there probably wasn't any hard money at play on this one, correct?
There was actually not
day one.
Not on day one. No, that's correct. Yeah, we didn't just because we knew that there were some foundation issues. We just didn't know the extent. The seller did know there was some, and some of them weren't able to be. They didn't have a certificate of occupancy. Some of them did, but we just didn't feel it was necessary to put hard money day one.
Mm-hmm. Yep. No, that definitely makes sense on that type of an asset like that. And especially with you being the really kind of the only one at that point, bidding on the property, you're not trying to compete with several other people. You didn't have to do something else to kind of stand out or anything like that too.
Yeah, it wasn't necessary. There were a few other people looking at the deal, but it just wasn't at the point where it wasn't a super competitive market to begin with. And so, if it's a really desirable property, I think that would be appropriate, but not necessarily in this project.
Yeah. What kind of issues came up during your due diligence process?
Yeah, so we actually, we knew about some foundation issues. I mentioned that there was about 3 or 4 buildings that had some heaving issues and some sinking issues, and we just didn't know to the extent. So we had a structural engineer come out with us, and actually 2 different structural engineers, and kind of give us the lay of the land, what they thought was happening. And it turned out to be actually a very simple issue, which was really a surprise to us. It's mostly just trees that are really close to the foundation. And so you have a tree next to the foundation that's pushing the building, and then the root system down below is sucking the water from the water table. So you're having a heaving and pushing issue. It turned out to be a fairly simple process to fix it. A lot of work, but pretty simple. So that was actually a surprise, which was nice. That was a good surprise. But we actually started pulling panels off, electrical panels, and found out that almost all of the units had aluminum wiring in it. And this was something the seller actually didn't know about. Apparently, when he purchased the property, either he didn't know about it, the lender didn't know about it, or it was all cash. I can't remember off the top of my head, but he was actually unaware of that. So we had to actually go through every single unit, because some of them had been fire damaged previously, probably from aluminum wiring, and they were replaced with copper wiring, which was standard. So not all of the units had it, but he didn't know to the extent. And so to get an actual bid on the electrical work, we had to actually pull all the panels off in every single unit and do our count. And when we got to that count, we discovered it was probably going to be somewhere around $300,000 to $400,000 to fix that problem, which was quite a bit of money that we didn't underwrite for. And so, we went back to the seller and said, "Hey, I know this is tough to hear, but our lender won't even close on this property unless we fix this or have a plan to fix this." And so we actually got a reduction in price. Wasn't everything we asked for, but it was enough to fix the problem.
So you talked about the lender having an issue with the aluminum wiring in that property. What about the foundation issues? Did they have an issue with that and you had to correct that too?
Yeah, so it'll come up. We purchased the property on bridge financing, so the process to close the property isn't necessarily what worried us. It was when we go to refinance. Once we've added the value, we wanted that to be something that was already fixed, so it wouldn't even come up when we went for that long term, either probably Fannie debt.
Yeah, well, that definitely makes sense. Anything else in due diligence?
That was pretty much it. We found out that it was actually in a really great area. There's some really great comps, and we didn't know to what extent, but it turned out to be a much better location than we actually initially thought of. So that was good.
As far as the rents are concerned, what were the average rents before you acquired the property?
They were sitting right around, if I remember correctly, 70. Yeah, so 79 cents a square foot. So roughly $656 was current market or what they were asking. And our plan was to actually raise those because they were under market anyway. But after a nice rehab, we were thinking somewhere around average rents 790, pushing 820, somewhere around there.
What's the unit mix?
So we had about 70, 80, roughly 90 one bedrooms, 75, 73 two bedrooms, and 33 three bedrooms. And the reason I'm kind of waffling is we had a mix of, sometimes they renovated a few of projects or a few units, but not to the extent that we were thinking.
Okay. And as far as the increase from the 656 average rents per month to the 790 to 820, let's talk about what you're going to do what your plan is for the interiors of the units.
Yeah. So we have a process that we've kind of gotten down to almost to a science. And this is in part due to our management company. They're a great manager in the area, but we've gotten this amenities package, which we can almost cut and paste into new properties. This includes things like depending on the level of rehab, we can either put new doors on our cabinets or just repaint them, new hardware, like nickel, brass, brushed nickel, hardware. We can do either black or stainless steel appliance packages. For this, we chose black. We can do either a peel and stick backsplash or just leave it painted. And then obviously part of this is new flooring throughout, LVT, wood, vinyl, something that is cheap and easy to maintain. And then obviously new paint, light fixtures, new carpet in some areas, and bathroom renovation. Definitely new toilets, mostly because they are the older type that are 3 or 4 gallons per flush, dropping down to 1.4 gallons per flush, which saves us money, and they get a new toilet out of it. So, and then either painting the bathtub, which is sort of the lower grade, or replacing the tub, which is sort of the more premium rehab.
And what's the plan for the exterior?
Yeah, so this needs a lot. We actually negotiated in roofs being replaced or money escrowed by the seller, which is cool. But we had that foundation work, which is going to be about 200 grand at least, to both cut down trees, to fix any sort of helical piers that might need to be placed in them, and then fixing our drainage issues. This is called Legacy at the Lake. That was the previous name. There is a pond or a lake right nearby. And so we do have some drainage issues that we need to fix. And then stairs, shutters, doors, things that need to be painted. And then seal and stripe on the exterior parking lot. So all these things just keep adding up, and there's a lot of exterior work. But I think that this is such a great location, and you know, we've gotten the work paid for. It's just executing at this point.
What's the stabilization and renovation timeline on this project?
Yeah, it'll definitely take a little longer. We have it underwritten. We would like to get it done in 18 months, but that's just not realistic. I think 2 years, 24 months is where we're stabilized at. And that's renovating roughly 6 units a month, which is, in our experience, something that's easily done with our renovation crew.
And question about the comps around this property. Do you have other comps that have already done something similar to this and you've kind of proven that business plan, or is this kind of a new thing that you guys are going to go into the market and test it?
No, we have a lot of comps. Actually, there's some comps that are maybe 200, 300 yards away, which are great. They're slightly newer, maybe a couple of years newer, but totally renovated, pushing rents. And actually the current property has, where it's at right now, has benefited from that a little bit as well. They've raised rates, but we think we can take it to that. The demand is there. We know we can push rents there, but we also own a property that's 186 units. That's, a couple miles away from there, where we've been testing this renovation package, this amenities package, and we know the rents that we're getting. And so we felt comfortable underwriting to those, even though we think it's a little better location and we can do a little bit better. But this is not something brand new. That's not our investment style. We like to have things that can be comped very easily.
And what's the hold period on this one?
So we'll do a bridge financing for 2 years. And at that point, we'll refinance out. We're underwriting a 6-year hold currently in our model. But, if things go well, that might be quicker. If the economic climate isn't where we want it to be at in 6 years, we'll hold on to it. We like to have a couple different options.
What did you do to finance this deal?
A lot. The bridge loan process when we were closing this still wasn't necessarily what's called stabilized, or wasn't at the point where it was a year ago when we were looking at this. So bridge financing was a little tough, but this was the perfect product for this property. It wouldn't qualify for any of the good stuff just yet. So we got 76 loan to cost, which is good. We got 14 grand a unit financed into the loan. And we had a little bit of interest reserve, which is pretty standard. Our interest rate was 7%. And that's for a 3-year term. So we have a 3-year term, but we're planning to be out in 2 years. And then hopefully refinancing into some long-term, maybe 7-year debt.
What was the COVID reserve on this one? I say COVID reserve. They're not trying to call it COVID reserve anymore. They're just calling it the reserve. But what was that?
Yeah. So we didn't actually, we had interest reserves, but we actually didn't have the COVID reserves that most people think of. Bridge lending wasn't necessarily that bad at that point. So we actually got out of that, which I think bridge lenders are doing right now. Agency still requires COVID, whatever, hold back. Right. I haven't heard of anyone getting theirs back, by the way. So
nope, not yet. We're coming up on a year on one that we closed in May of 2020 that we're supposed to be getting back. We're supposed to be getting it back after 9 months. So once we hit that 9-month mark, we'll definitely be trying to get it back. So
yeah, I think I talked to a mortgage broker yesterday and she mentioned like she hasn't heard of anyone getting theirs back yet. And if you are coming up on that year, just to hound them constantly because they'll find a reason to keep it. So hopefully, and that's a good point right now. Moving forward, underwriting deals, I'm underwriting as though we're not getting that back for 3 years, because at 3 years they have to give it back. But that's the safe way right now.
Yeah. Yep. Yeah, it's tough because they hold on to it for forever for as long as they want, and you're not earning anything off of that. It's just sitting there doing nothing. So it's very frustrating. So
absolutely,
it's good that you didn't have to put that in this particular project with this type of debt structure that you have in place. Yeah. So what'd you do from a structure with your investors? How did you structure this project with your investors?
Yeah, so this was a pretty simple structure as far as things today wise. We just did a straight 70-30 split with an 8% preferred return, and that's pretty typical of everything that we're doing these days. Year one, they're looking, not great cash flow from a standpoint of looking at your 1 year return, but that's not a surprise. frankly, we're adding a lot of value in that first year. And so it's going to be smaller returns. But once we do that refi, I think, and stabilize the property, it's going to look pretty good.
Now, do you do a cumulative preferred return?
Yes.
Okay. And then on the 70-30 split, there's no secondary hurdles in the waterfall or anything like that. Just the first hurdle is the 8%, and then it splits 70-30 after that.
Yes, exactly. Yeah.
Okay.
It's pretty simple.
And how much did you end up raising on this project?
The total raise was just under 3.8 million right now.
Okay. And how did you go about raising the capital on that project?
Yeah, we this was a popular project for some investors, not so popular for others. I think the more like the newer folks were a little intimidated by all the work that had to be done. A lot of our more sophisticated investors recognized that there was a lot of opportunity here. So this was just a straight friends and family deal. We didn't go to any outside equity groups or anything like that. We raised it, $75,000 at a time. And, we're pretty proud that we did that during Thanksgiving, during COVID, pushing Christmas. So it wasn't the best time to be raising, but we got it done.
How many investors overall in this project?
Ooh, that's a good question. Probably, I can find that out, but probably if I had to guess, around 35 to 40.
35 to 40. And one of the things I was going to mention about the investors and their appetite on this project is obviously with COVID, one of the biggest issues that we've seen is the lower end assets, the C-class assets having a harder time. So how did this particular asset perform? How was the physical occupancy versus the economic occupancy, and any bad debt or anything like that?
Yeah, good question. Overall, this fared very well during COVID, and part of that is the tenant base, which was mostly there were some retail jobs mixed in, but a lot of them were healthcare workers. And so occupancy was low anyway because of those buildings that weren't able to be occupied. And then we had our, stabilized occupancy, which was a little bit low for us in the beginning. So I think that we'll see. Time will tell where things are going to end up. Most people just got their stimulus checks. So we saw a bump in collected rents now. Tax returns are coming in February. So I think we'll see another bump then. Past that to March, who knows? It's anyone's best guess if we're going to have another lockdown, or it doesn't look like that's going to be the case, but you never know. So we underwrote, a very healthy, very significant year one vacancy. And I think we can stick to that pretty easily. We have a low break-even occupancy, a low break-even rent number. I feel pretty safe with this one.
So what other issues may have come up on this property throughout this entire process that we haven't touched on yet that you think might be good for our listeners to hear about?
I think for the most part, one thing we learned early on is that the sheer amount, like you can have a property with infinite value that you can pump into it, but there's a threshold to what investors will accept. If you're going in and doing a lot of exterior work to a property, that's not ideal because you don't get paid for a non-leaking roof. Tenants just expect that. So there's a threshold to the amount of exterior value that investors will swallow. Right now, we're pushing that threshold. We have replacing wiring with copper wire or aluminum wiring with copper. We have some foundation issues. The roofs are being replaced, but we didn't have to pay for those. But that's still something that they need to take into account on top of doing a premium rehab. So I think the one thing that investors and limited partners as well need to understand is, this is something that's not for someone who's brand new to this. This is someone who has a very detail-oriented asset management mind, because even during Christmas, we had crews working. Of course, we didn't make them work Christmas Day, but we closed on that property. We had a plan in place, and we've already replaced 35 HVAC units. We're already pushing 5 units that have already been done. We're waiting on countertops for a couple of them. This is something where we hit the ground running and we have a plan to get it done quickly. And so having that experience behind you is something that all investors need to pay attention to, because that's not a small project.
So I have two final questions for you as we wrap up this episode. They're both kind of contrasting questions, and I ask them to every one of our guests that come on. First one is, what did you find that was easiest during this entire process that maybe originally you thought was going to be a little bit harder?
Most certainly it was the foundation. I thought that was going to be a big issue for us. Frankly, when people hear foundation issues, they get scared. However, it turned out to be a very simple process. Both structural engineers agreed that it was a simple fix. They differed on how to fix it, but that's okay. And so that was actually a big surprise to us. It turned out to be not a huge issue at all.
And the final question to you is, what did you find that was maybe harder than originally expected during the entire process that maybe you thought was going to be a little bit easier?
I don't know if I necessarily thought it was going to be easy, but the financing was tough. COVID really messed up the debt markets. And so finding the right product for this was difficult. And finally we came across a lender that really liked this project and was able to fit all the pieces in together, but it wasn't easy. And right now, the lending market in general is not easy. So that's something to think about moving forward.
Yeah. Well, Lucas, I really appreciate you taking some time here with us today and sharing all your insights into this acquisition. How can the listeners reach out to you if they want to ask you further questions on this particular acquisition, or maybe they want to follow you and potentially partner with you on one of your future properties?
Yeah, thanks for that. I appreciate that. I actually have a podcast where I focus on, asking passive investors questions about getting started and how they've done things. So you can find us at fearfreepassive.com. And we have podcasts, we have YouTube videos. And if you go to that website, there's an Invest With Us link if you're interested in that. But we've got lots of great content there and hope you stop by.
Awesome. Well, thanks again so much for being here with us today, Lucas. Looking forward to continuing to follow you as you continue to close more deals in the new year here, and looking forward to having you on a future episode.
Yeah, thanks, Dan. I appreciate it.
Thank you.